welcome to your rapid fire morning explainer. We are jumping right into the overnight macro shockwaves, and more importantly, the exact tactical levels you're going to need to navigate today's session. Look, if you're out there trying to find the signal amidst all the noise, you are absolutely in the right place. We've got a ton of ground to cover today across major currencies, Indian equities, and the broader global setup, so let's get right to it.
Okay, let's kick things off with a number you absolutely cannot ignore today. $88. Brent Crude just climbed right above $88 a barrel, posting its absolute strongest weekly gain in months. What's driving this? Broadening U.S.-Iran conflict fears. And this surge is completely reviving imported inflation anxieties right when central banks thought they were finally crossing the finish line. You know, markets have this remarkable ability to just ignore geopolitics, right up until oil decides to remind everyone who's actually in charge.
And these shifting macro forces, they're creating a massive global divergence. On one hand, the US is still the standout performer, riding on softer inflation data that hints at a resilient economic landing. But then, you look across the oceans and it's a totally different story. Europe is just stuck in low gear, and China's recovery is, well, incredibly uneven. I think investors are quickly waking up to the fact that while optimism is free, having true market conviction right now is getting really expensive.
Meanwhile, remember that intense AI euphoria? Yeah, that just met a very harsh reality check. Last week, the Nasdaq got dragged down almost 3%, and semiconductor shares actually slipped straight into bear market territory. This sent investors aggressively scrambling into the safety of government bonds.
Looking at the week ahead, economic data is completely in the driver's seat. We've got a heavyweight calendar lined up: global PMIs, US jobless claims, UK inflation, and that highly anticipated ECB policy meeting. This barrage of data is going to be the ultimate test to see if the manufacturing sector is finally joining the recovery or if it's just going to keep ghosting the global economy. Pivoting over to the US dollar index, or the DXY, we've got some pretty fascinating fundamental developments. A better-than-expected UMIC consumer sentiment survey just hit the wires, and that was heavily boosted by a temporary drop in energy costs. But make no mistake, the markets are still bracing for geopolitical impacts. What's wild is that the probability of a July 29th Fed rate hike has basically fallen off a cliff, even while the US 10-year bond yield is stubbornly holding above that crucial 4.53% mark.
So how do we trade this? Technically, the DXY is still a rock-solid buy-on-dip setup. We've established a really clear floor of support right in that 100.47 to 100.57 zone. If we push higher, look for immediate resistance at 100.89, and then a secondary ceiling up at 101.41. Definitely keep those levels mapped out as your day unfolds.
Jumping over to Europe, the bond markets are screaming a completely different story. Germany's 10-year bond yield just spiked to 3.151%. We're talking multi-month highs here. Regional markets are aggressively repricing energy-driven inflation, and they are completely ignoring the inline Eurozone CPI prints in the process. And honestly, this perfectly illustrates the exact fear that ECB President Christine Lagarde was talking about. Speaking at the European Parliament, she warned that the full implications for medium-term inflation hinge entirely on the intensity and duration of this energy price shock. The central bankers know exactly what's at stake. So, what's the playbook for the euro? EUR/USD ended the week just a bit lower, and our technical setup here is a strict sell-on rise. You are going to hit some really stiff resistance at 1.1447 and again at 1.1483. On the downside, keep an eye on support at 1.1388 to catch the falling knife. All right, shifting our focus over to Asia, the million-dollar question for currency traders today is the USD JPY. Which direction is this thing going to explode from its current extremely tight range? The pair is officially locked in what we call a squeeze zone, which means a break on either side is going to trigger a massive, volatile move. Fundamentally, this is all being driven by Bank of Japan indecision. Right now, swaps are pricing in only a 32% chance of an incremental 15 basis point hike at their upcoming review. Basically, the market is betting on a hold. With the 10-year JGB yield edging up to 2.712%, domestic markets are adapting to the BOJ tapering its bond interventions, and that leaves the currency perfectly coiled between two really critical technical triggers. Tactically speaking, this is a strict no-trade zone. Seriously, do not get chopped up in the middle of this. You've got to wait for a conviction break.
Only deploy your capital if it firmly breaks above 162.71 or breaks below 161.30. Patience is absolutely your best friend on this one.
Now, heading over to the UK, it's actually a wildly resilient story for the currency. Even with BOE Governor Andrew Bailey giving these stark warnings to the Treasury Committee about the long-lasting impacts of geopolitical conflicts on inflation, cable remains the best-performing major currency against the dollar right now. The dips are just continuously getting bought up. With UK economic activity actually picking up and the 10-year yield testing 5%, cable is a super strong buy-on-dip setup. Your upside target here is 1.3558, and that's protected by some really solid safety nets of support at 1.3450 and 1.3393. Okay, let's zoom in on our India focus. The macro dynamics here are creating an unbelievable tug-of-war. The rupee just logged its sharpest weekly drop since May, completely buckling under the weight of escalating US-Iran tensions and that $88 crude oil price we talked about earlier. But what's crazy is that this oil shock pressure completely overpowered a massive surge in foreign inflows. Overseas investors actually poured $1.5 billion into Indian equities and another $500 million into debt just this month.
So, looking at the technicals, USD INR closed at 96.28. Even with those heavy foreign inflows, the dominant oil narrative keeps this pair on a buy-on-dips trajectory. The next target is aggressively positioned up at 96.90, with your support resting safely between 96.18 and 95.82. And finally, let's talk Indian equities. Yes, they outperformed global peers, but it masked a pretty serious hidden divergence under the hood. Sure, the headline Nifty closed up 1.09% at 24,334. The heavyweights in IT and banking rallied beautifully, completely shrugging off the Middle East concerns. But the broader markets? They completely missed the memo. The Nifty Midcap Index actually bled out 0.41%, and the Small Cap Index dropped 0.21%. So, your tactical playbook for the Nifty. It's still buy on dips, but you've got to watch that 24,344 pivot point like a hawk. If we can actually sustain a break above 24,344, we are marching straight toward 24,561. But if we slide back below it, you should expect a much deeper correction down to that key 23,900 support level.
So, as you're getting your portfolios ready for the opening bell, I want to leave you with this final thought. Will this incoming barrage of global data finally stabilize the economic narrative and give us the clarity we so desperately need? Or will oil and global yields just keep reminding the markets who's really running the show? Keep a very close eye on those tactical levels today, stay disciplined out there, and I will catch you in our next explainer.